What's up, millennials? In exchange for your time, and hopefully you like as well, today we are going to take a look at the valuation of a company called Ouster. Ouster is a lidar company and is going to be acquired by the SPAC under the name Colonnade Acquisition Corp, which so far is trading under the ticker symbol CLA. And I'm talking about this SPAC because the interest in lidar companies seems to go up a little bit, and I also received a comment about the CLA stock. Before we start, a few things first though. First of all, I haven't done extensive research about this company just yet. I'm just going to look at the valuation based on the investor presentation, right? So these valuations are not based on my opinions, just the numbers from the investor presentation. Secondly, don't trust me, verify me. I'm just a random dude on the internet. I'm not a financial expert, not a financial advisor. I'm just trying to document my journey here. And third, Stock O'Clock. These are very short 1-minute videos that I post every single trading day with news about the stock market. Alright, so we're just going to jump right into it. If you have already watched a few of my videos, then you probably know more or less what we are going to do. If you want any more information about the company itself, so Ouster itself, then I would recommend you go to the investor presentation. I'll put that in the description below this video. In this video, we're just going to take a look at the valuation, so I'm not really going to talk a lot about the company itself. So the first step that we're going to do is to look at the pro forma valuation, right? And for that, we're going to use the numbers from the investor presentation. So pretty much like all SPACs, they're using a base share price of $10, and they say that they are going to have about 185 million shares outstanding after the merger. So that's going to give us a pro forma market cap of $1.85 billion, of course. And then you can see that they are going to have about $280 million in cash on their balance sheet. So that means that you can take the market cap of 1.85 billion, then you can take off the amount of cash, and then you're going to arrive at a so-called enterprise value of $1.57 billion. And that is basically how much the company Ouster is worth after the merger. So those are the numbers that I put in my Excel sheet as well. And as you can see though, the price of CLA, of Colonnade Acquisition Corp, has gone up to $13.50 right now. So that means that our numbers, our market caps, and our enterprise valuations, very difficult word, have also gone up, right? So as you can see, if we put in 1350, then we can see that the current pro forma enterprise value is $2.2 billion instead of $1.57 billion. So that is already gone up a little bit. The next step for this valuation video is to look at the enterprise value, the future enterprise value rather. And for that, CLA, Colonnade Acquisition Corp, and the company that's going to be acquired, Ouster, have already helped us out a little bit. They gave us an enterprise valuation between $8.3 billion and $10.3 billion. They only said that they were calculating that based on the EBITDA of 2024, but it didn't give us any specific multiples. So we can actually go ahead and calculate those multiples ourselves. First of all, we would need to know the EBITDA of 2024, so the predicted EBITDA. And if we scroll up a little bit, and then we can see right here in the EBITDA row pretty much that they in 2024 expect to have an EBITDA of $254 million. 254. Keep that in mind. Okay, so the low future valuation they say is going to be $8.3 billion. So if we divide that by the $254 million in EBITDA, we're going to arrive at a multiple of 32.6, which is basically kind of reasonable if you compare that with the other lidar SPAC companies that we have been taking a look at. As you can see, they compare themselves with Velodyne, with Aeva, with Luminar and Innoviz, and we already talked about a few of these SPACs, of these lidar SPACs. And we know that these multiples of about like 34 to 44, something like that, is pretty reasonable. So that's for the low valuation. They took an EBITDA multiple of 32.6 more or less. And then for the high valuation, which is $10.3 billion, if we divide that by 254 million, the EBITDA of 2024, we're going to arrive at a multiple of 40.5. So that seems pretty reasonable as well if you compare that with the high valuations of the lidar SPACs we have taken a look at in previous videos. So to recap this step, then the future enterprise valuation is going to be $8.3 billion, and the high future enterprise valuation is going to be $10.3 billion. The thing is, however, that we want to know the current enterprise valuation, right? So now we know the future enterprise valuation, $8.3 to $10.3 billion, but we want to go to the current enterprise valuation. How do we do that? Well, first of all, we can apply a formula to go there. And we need two things for that. First of all, we need to know the amount of periods we need to go back. Right now, we have been using an EBITDA of 2024, and we're now living in 2021. So we need to discount it back 3 years in time, right? 3 years in time. The second thing we need is a discount rate. And as we can see in the investor presentation, they use a discount rate. It's very small, but maybe you can see it. A discount rate of 20%. 20% is quite normal for SPAC valuations. I've seen 20%, usually it's 20%, sometimes it's 15%, but yeah, mainly it's 20%. So now we can apply a formula to these future valuations to arrive at a current enterprise valuation. How do we do that? Let's first take the low valuation of $8.3 billion. We divide that, first of all, by 1.2. The 2 here is standing for the discount rate of 20%. And we do that to the power of 3 because we need to discount it back 3 years in time, right? So that is going to give us a current discounted enterprise value of $4.8 billion more or less, which is also the number that's calculated by my Excel sheet and also the number that's present in the investor presentation. So that's all good. Then we are going to do exactly the same thing with the high future valuation. So we take $10.3 billion, we divide that by 1.2 because of the discount rate of 20%, to the power of 3 because of those 3 years we need to discount it back for. That gives us a current enterprise discounted valuation of about $6 billion. Which is also the number in my Excel sheet and also the number in the investor presentation. Now, if we add one more valuation, we're going to call that the midpoint valuation. It's basically going to be the average of these two numbers, so 4.8 and 5.96, which is going to give us a midpoint valuation of about $5.4 billion. For our next trick, we are going to look at the fair market cap and the fair price per share. How do we do that? Well, first of all, we take those enterprise valuations, so these numbers, and we add back the amount of net cash that they are going to have on their balance sheet. Because remember, the market cap is simply a calculation of enterprise value plus net cash. So we do that. First of all, let's start with the low valuation. $4.8 billion plus the almost $0.3 billion. So that gives us a fair market cap of $5.1 billion, more or less. For the high valuation, it's 5.96 plus 0.28. Gives us a market cap of $6.24 billion. And then for the midpoint valuation, it's going to be $5.66 billion, a fair market cap. To arrive at a fair price per share, the only thing we need to do is divide these market caps by the amount of shares outstanding after the merger. Right now, there are a lower amount of shares, of course, but after the merger, as we said in the beginning of this video, there are going to be 185 million shares outstanding. So we take these market caps and we divide them by the amount of shares, and that is going to give us a fair price per share. So for the low valuation, that gives us a fair price per share of $27.48. For the high valuation, $33.73, and a midpoint fair price per share is $30.61. And as you can see, we can also calculate the percentage, the growth percentage basically, versus the current price per share of $13.50. So as you can see, for the low valuation, we can still appreciate 103%, high valuation about 150%, and midpoint valuation 127%. All right, so there you go. A fair midpoint price per share would be $30.61. And that could mean that we could now appreciate 127% based on the current price per share. However, don't trust me, always verify me. I could be completely wrong. I am just a random dude on the internet documenting my journey. And also keep in mind that we haven't taken a look at assumptions, right? We have taken a look at a certain predicted EBITDA for 2024. We have taken a look at a certain EBITDA multiple as well. So if you change one of these numbers, the entire calculation is going to change as well. And that means that the fair price per share is also going to change as well. With that being said though, thank you very much for taking the time to watch this video, and I hope to see you in the next one. Bye bye.